It's Thursday, April 29th. This is The Street Live. I'm Katherine Ross, and I am joined by Jim Cramer. Jim, what has caught your eye in this market? We do have the Dow and the S&P higher and the NASDAQ lower.
Once again, over-enthusiasm at the opening. We've had a real bad pattern here, which is that we open high and then we give up the gains. Very few stocks are able to buck that onslaught. So you even have a company like an Apple, which reported a fantastic quarter. It just can't sustain it. Very much like what happened with Advanced Micro yesterday. So I don't like the action. I think that what happens is you have to have that cleansing where people just stop trying to buy a stock when it's up big, which is something we do the opposite of in Action Alerts, and instead focus on good fundamentals and stocks that may be on a discount, not or on a premium.
So, Jim, yesterday we discussed AMC and Microvision as two meme stocks that you were watching, and I want to open up this chat again. Are there any other meme stocks that you're eyeing right here?
Well, look, I am a big believer that Adam Aron will pull off AMC now that we're going to be all open. I mean, I think that this is a fantastic story. I mean, New York is going to be open. AMC's got plenty there, and they're selling 40. So they're selling 40 million shares. They could put that out in a second. There's already 11 million shares have traded, and it's only 1036. So I think AMC is very, very good. I like that meme stock. And I wish that they would, the meme people would adopt a few more names. They always seem to be so concentrated in just a limited number of stocks, in part because I think that's all the ones they think they can control at one time. So I do like AMC, and I like the fact that Adam is selling the stock to make the balance sheet good.
So yesterday in your no huddle offense on Mad Money, you said that the market gets really stupid as we handle what you have called the Gauntlet, which is the time period that we're in right now. And I've noticed a lot of frustration in both of our mentions on Twitter, Jim. So I want to see if you have any advice for investors who don't understand why stocks and their portfolios are being hit by earnings that might not have been so bad.
There is a huge amount of frustration, and a lot of it gets taken out on me, which I say fine. Doesn't bother me. But let's take a stock like ServiceNow. I interviewed Bill McDermott today. Bill McDermott is just fantastically bankable. He has since he took over ServiceNow. And before that, Frank Slootman was at ServiceNow, and John Donahue was at ServiceNow. And it's just been a company that doesn't have a lot of competition. And this is for workflow management, a Willy Wonka ad campaign right now. And as the market drops, and it's been dropping the whole morning, you want to start taking a look. This is a good example. Stock's down 41. Okay, now it is admittedly a $500 stock, but this is one where you can presume that the market's ugly. So 41, maybe it's down 65, 70. Yeah, it could get that ugly, but minimum it could be 50. And that's the stock that's being put on sale by the Gauntlet. Why? Because you can interpret a lot of the negatives as being actually neutrals. I mean, there are people who feel that he guided down. I think that what he did was set you up for a fantastic May 10 analyst meeting, which of course is not that far from now. So where I think he'll pull the rabbit out of the hat and do exactly what's necessary. So I say with the stock down 41, you start, maybe you pick some up, you use fractional shares, and then you wait till down 50. The worst that happens is you just buy some at 41. You can't buy it all at the same time because the market's too horrible. When I say horrible, I mean it just cuts your heart out. I mean, you take a look at AMD, which is my focus, and it's back to 83 with the best quarters ever reported. It just doesn't seem to matter. And we'll talk about Bristol Myers, the Action Alerts call. But if you miss, I mean, heaven forbid, if you miss, you're dead.
Jim, I want to obviously dig into earnings since we're in the thick of it right now. But before we do that, there was one headline that caught my eye, and I believe it caught your eye too. The CDC has finally given the clearance for cruise lines to resume cruises in July. I mean, this has been a huge issue for you. So now that we know that they can possibly resume their cruises, do you think that any cruise line is a buy?
I mean, they think they are. And Norwegian is the one that's best capitalized. Richard Fain, great operator, Royal Caribbean, but it's Norwegian, and Norwegian's they're going to be sailing. Now, they have about $7 billion in debt. Now, that's like owning an airline stock. But what we know is that there are people who buy stocks based on stories and momentum, and they're not going to look at the balance sheet, particularly those people who are the younger investors. The younger investors are so powerful they can make themselves right. I did a piece last night about how the people from the meme people from Wall Street Bets, they make themselves right all the time. And typically that's not been the way people invest. They look at They don't look at the short position and figure out whether they like this, whether they think the flow is good. But Norwegian's got a 12% short position, which probably intrigues them. Maybe not. Maybe I skip to like 20%. I don't know. But it is, if they can cruise, it's going to make money. And so therefore, all the estimates have just been pulled through to be better. And so I like that stock very much. But I have for a long time.
So when we talk about airlines, Jim, you're not super bullish on any of them because of the debt and because of COVID. No, that's what I was going to say, is that you like Southwest. So is Norwegian to you comparable to Southwest in this regard?
Absolutely. And best operators. This Southwest has been nothing but net. I continue to think it's a terrific company. Gary Kelly has used this period, the CEO, to take advantage, bought a lot of planes, taking over a lot of routes. Plus, I think that we look at oil, which I know on the longer term is not up on the curve, but on the short term is up. And I think that means much more activity in the Permian, which means that you want to own Southwest Air.
Another stock that both you and I have been looking at this morning, Jim, is Qualcomm, and it was your mad dash, and you actually said, and this is a direct quote from you, that this is the one that will be the most after Facebook. So why is the stock such a winner in this market?
Okay, because Qualcomm missed the quarter previously, and a lot of people felt like that it missed signaled that it was not going to do well in 5G, and that 5G was over, and they're not going to play in the cycle, and that they're not going to have that big pop that people felt they would have from 5G. This quarter explained everything. This quarter was a quarter where they got the pop, where the numbers are coming right back up, that people who, whatever they lost last time, they picked up this time, and then some. So, and Qualcomm's also, you remember, it's a $160 billion stock. Qualcomm is a loved stock by Wall Street because it has been historically just this real asset-light business. And I think it's going to regain that luster, and you have to own it right here.
So one company that has forecasted lower than what Wall Street wanted to see is eBay. That's just not impressing you, Jim. This was also your stop trading. You said that they have turned into prey and not the predator, but you noted that they could make acquisitions to kind of bring them back.
Well, I mean, we look at a Poshmark, which my daughter's on all the time, or you look at a Real, which my wife is on, and you say to yourself, well, what are these companies? Well, these companies are versions of eBay, and eBay needs to be in that kind of business. They need to be in StockX. Maybe they should buy StockX. They have cash. I mean, you can't let these models beat you. I once met with Jeff Gannett, and I said, you know what? You ought to buy Stitch Fix, for heaven's sake. Well, let's see. Macy's is $5 billion, all right, and it's around 16. And Stitch Fix is $5 billion. Well, there you go. I mean, I think that it's 4.8, but Stitch Fix did trade as high as $10 billion. And that's a very good management team. That's Katrina Lake. She's stepping up she's going to be chairwoman, but will be active. You know, these companies, they have the ability to wreck your core business. And so you have to make one yourself and not think that it is necessarily going to cannibalize you. It's going to be additive. And eBay didn't do that. eBay's a mess.
I just wonder, Jim, I like what you're saying about the acquisitions, but I wonder how much of a rebrand they need to do. I mean, to me, it kind of feels like Blockbuster and Netflix, where you're seeing a bunch of other companies take this model and pull ahead with these more interesting branding, and eBay's just kind of stuck behind.
Yeah, well, I think that's true. I mean, they have a decent balance sheet. They had that StubHub, which I liked very much. They got rid of that. Obviously, they had this fabled split up with PayPal that was just ridiculous. I've been in favor of PayPal ever since the split. And so it's kind of I've used it, people have used it, but it's yesteryear. It has a yesteryear feeling. I think Blockbuster is pretty harsh because this company's got some things going for it, but I totally get the metaphor.
So, Jim, with that, let's dig into some of the biggest earnings reports that I'm sure our viewers have been anxiously waiting for us to cover. And that I want to start with Apple, because they did report quite a quarter. However, they didn't reinstate guidance, but they did authorize a stock buyback. With this quarter, Jim, do you think that this chip shortage that, everyone's a little frightened of should worry investors in Apple?
No. I think the second quarter is going to be the trough of the chip cycle problem. That's something I got from Jim Farley at Ford. I think that Apple's very powerful, can multi-source. Apple delivered an amazing quarter. The fact that you're getting the stock for almost unchanged is kind of crazy. The estimates were handily beaten. And I think that Apple is It's a must-own. It's a must-own. So those who haven't bought it should buy it now. And you want to own it, not trade it. Look what happened with Rod Hall, a very good analyst at Goldman Sachs. He tried to own it, not trade it, and he had to sell on it. And he had to throw in the towel today. He had to admit that he was wrong. Tony Sacconaghi, how many times is he going to come on at 120 and say, hey, listen, I don't like it, and then the stock goes to 134? I find too many people want to call the top in Apple. And when I spoke to Tim Cook yesterday, I was talking about some of the things that I think are really important here, which is the lifetime value of a customer and how much they take each customer. And I came back, even though they were not, let's say they weren't on my same page. I came back thinking every time they sign, every time they get a new customer, whether it be for anything like watches, whatever, it means that the ecosystem's in play. And I find that the ecosystem is really fabulous, and you want to own Apple, and you want to pay, right? You want to buy some here, and if it goes below its basis today, 134, I think it can really cascade. So you buy the second point there.
So I want to focus on stock buybacks for a second here, Jim, because during the height of COVID, people questioned stock buybacks and whether or not companies should be doing them. But now we're starting to see companies authorize buybacks again. What are your thoughts here?
Yeah, I mean, I think these buybacks are pretty big, but I don't know how aggressive they are. I mean, I don't know if they're buying, do you come in tomorrow and start buying? Are they on the bid side? I think the buybacks are mysteries, and they tend not to mean anything. Now, but then at the end of the quarter, you see that they retired X, and then makes it so that everything else is more is valued more. But what we need to see is the end of underwritings. I mean, we're deluged with stock. Today was Endeavor. Candidly, they're my agent, and I look at Endeavor and I say, well, that's another $5 billion. I mean, we just have too much stock. So the fact that these guys is a drop in a bucket, what Apple's doing and what Facebook's doing and what Google's doing, just a drop in the bucket versus what all the equities, even though they seem like incredibly large numbers. That's how I feel about it.
So despite an excellent earnings report, Ford is down over 9% today as it's being hit because of the chip shortage, Jim. And you sat down with CEO Jim Farley on Mad Money last night. You noted that Farley has fixed the problems at Ford, but this chip shortage is just really putting pressure on the stock. So where does Ford go from here?
Well, I mean, I think that we have to take Jim at his word when he says the second quarter is the trough. And if that's the trough, you got to buy a hand over fist. That's why we upgraded it. I mean, I would buy Ford right here, right now. I mean, 11 and a quarter after a quarter where Jim Farley said that we're going to solve the chip dilemma. So, I mean, I don't know what you're waiting for. If you're thinking about buying Ford, I think you're already too late.
All right, now this stock I'm about to mention, Facebook, I want to dig more into over on Action Alerts Plus. It is up over 5% after a great earnings report. But Jim, what did you make of this quarter?
Well, I mean, they mint money without having to do anything. I mean, they just, it's your content, not theirs. So it's like it's a newspaper that people write. They had some virtual reality stuff that can even move the needle. But what I like about their model is that they continue to get monthly average users, in the billions, and so that means that they've just scratched the surface when it comes to advertising, direct response advertising. I mean, I've looked at it for Bar San Miguel Instagram, and I've looked at it for for Longshoreman, which is the two restaurants we have in Brooklyn, and we're going to use it. It's effective advertising. So I mean, it's just a good deal because it's so targeted. And that's what they got in trouble for, but that's what we want if you're an advertiser.
You've been focused on small businesses for quite a while with Facebook. I'm wondering if, as a small business owner, you think that they're doing enough with Instagram.
Well, I think that they are. I just didn't like the fact when they, in a kind of a disingenuous way, attacked Apple, saying that Apple's change is going to hurt small business. I mean, really, guys. I mean, that was a bridge too far for me. Small businesses don't track the way a Yum might track or a Domino's might track. I mean, that's just silly. Do they think they do enough? They have to do more for the minority community. Everybody does. You just have to do it.
And with that, we're now heading over to our daily rundown show over on ActionAlertsPlus.com. Come join us for an in-depth conversation on Bristol Myers, Facebook, Apple, Ford. These are all stocks that are moving the market today. Come join us there. I'm Katherine Ross. We'll see you tomorrow.